Hey, and welcome to The Explainer. You know, there's this one topic you hear about all the time in the financial news, one that's often treated like some kind of economic crystal ball, the yield curve.
Okay, so let's just jump right in. Can a single graph really predict the future of the entire economy? I mean, think about it. Every single time there's even a whisper of a recession, you see it everywhere. Journalists, economists, all pointing to this one specific graph. But what is it really, and how does it supposedly see the future? That's what we're going to unpack right now.
You know, when you boil it all down, this whole mystery, it's just about the shape of a line. Seriously. On the left, you've got its normal shape. This makes total sense. You get paid more to invest your money for a longer time. Simple. But on the right, that's the inverted shape, the one that freaks everybody out. This is where you actually get paid less for tying up your money for longer. Why on earth would that ever happen? Well, to figure that out, we got to start with the absolute basics.
So to figure that out, we've got to go back to square one. Before we can even talk about the curve, we need to get a handle on what it's actually plotting. And at its core, that's interest rates, which are basically just the price of two things, time and risk.
Okay, there's this core economic idea called intertemporal equilibrium. And I know that sounds super complicated, right? But stick with me, because the idea behind it is actually pretty simple. It's just the market sweet spot. That perfect balance point where the return you get from an investment is exactly what investors need to be convinced to part with their money in the first place.
So how do we find that sweet spot? Well, it all comes down to two really simple rules that, honestly, you already know intuitively. Rule number one, the longer you're willing to part with your money, the higher the return you're going to demand. That's your premium for waiting. And rule number two, the riskier the investment is, the more you're going to demand as compensation for taking that risk. More time, more risk, it means you expect a bigger reward. Makes perfect sense, right?
All right, so we've got our ingredients, right? Time and risk. Now we can finally see how they get put together to make the graph itself. The yield curve is just a way of plotting all those sweet spot interest rates across a bunch of different time horizons.
So what is the yield curve? It's really just a picture, a snapshot in time of all those equilibrium points we just talked about. And you got to remember, it's not just one curve. You have different ones for different levels of risk. So the curve for super safe, AAA-rated bonds looks way different than the one for riskier, BBB-rated ones.
Okay, let's make this real. Imagine you've got a super safe, like AAA-rated 10-year investment. The market might look at that and say, yep, for that, we need a 3% return.
Now, watch this. We keep the time exactly the same, still 10 years, but we dial up the risk, say to a BBB-rated investment. Suddenly, that required return skyrockets all the way to 8%. Same time commitment, but way more risk means a much bigger reward is demanded.
Okay, pay attention here, because this next part is super important. It's a detail that trips a lot of people up when they're looking at these charts. We've got to talk about what these percentages actually mean. They're what's called annualized rates.
And our source material puts it perfectly. It says that when you see a 4% rate for a 30-year investment, it doesn't mean you get a lump sum after 3 decades. No, it means you get a 4% return each and every year for those 30 years.
Let me give you another example to really nail this down. If you see a 1% rate for a 1-month investment, what does that mean? It does not mean you get 1% after 30 days. No way. It means you get 1/12 of that 1% in that single month. See? Everything is put into this common yearly language, this annualized rate, so we can actually compare them fairly, apples to apples.
So, when all is said and done and the market is behaving normally, where investors want more money for longer time frames, the curve gets this classic concave shape. It slopes up, but then kind of flattens out the further you go. This is what a healthy, normal yield curve looks like.
And that brings us right back to the million-dollar question we started with. If this upward slope is normal, what in the world could make it flip upside down? Why would investors ever demand more for a short-term loan than a long-term one? It just seems wrong, doesn't it?
And look, this isn't just some boring academic debate. Cracking this puzzle is the key to understanding why this simple line on a chart has been an almost freakishly accurate predictor of recessions for the last 50 years. It's the code we're here to break.
So how do we explain it? Well, economists basically have 3 main theories. First up, you've got the market segmentation theory. The basic idea here is that short-term and long-term investors are in completely separate sandboxes, and the curve inverts when the long-term players all rush for safety at the same time.
Then there's the liquidity preference theory, which argues that investors always prefer to have their cash handy, so an inverted curve signals an extreme level of fear about what's coming. And finally, the most popular one, the expectations theory. This one says an inverted curve is the market's collective wisdom screaming that a recession is coming, so investors are locking in today's long-term rates before they drop. 3 different lenses on the same massive warning sign. We're going to dive deeper into each one next time. Thanks for joining me.